Hey guys, Doug the Retirement Guy. We got some new exciting stuff for you today. Granite Shares just opened up 5 new weekly paying dividend ETFs. We got them all here. We're going to go through them. We've actually already invested into them, and we're going to explain to you how we're doing and what their strategies are. So we got a lot of great news here. But first, I want to give you guys all a big pat on the back. You've been hitting that subscribe button, and we want to tell you straight out. We've been approved by YouTube for membership. We've put 2 different memberships out there. One's 99 cents, one's $2.99. Take a look at them. Become a member. Support the channel. Help you continue to grow your pocketbooks. Let's get into today's video. So who is Granite Shares? Well, Granite Shares basically opened up in 2016. They were backed by Bain Capital Ventures, and they are leading ETF investors. But basically, what these guys have done, they've come up with a cutting edge alternative investment solutions. So they're looking at different ways to do ETFs, not the standard old fashioned way, just constantly, buy a stock, sell options, calls, different stuff. They've done some unique different things. Their first ETF was put into the United States in 2017. They've offered a broad base of commodity index funds, physically backed with gold and platinum. And then they've done some high income pass through in the security index. They've probably spent the past, 2.5 years now of expanding into the London, the UK market. So that's why you haven't heard a lot of Granite Shares. They are very out there with monthly and now weekly paying dividend payouts. And the weeklies, they've introduced 5 new ones. One that's going to be basically Tesla times 2, trying to just increase the return from Tesla, which is a very interesting one. They're going to have the NASDAQ 100 QQQ package. They're going to have the S&P 500. They're going to have Nvidia, and they have Bitcoin. So let's take a look at each one of these independently and see what they're all about. So the first one we're going to look at is the TSYY, which is the Yield Boost Tesla ETF. Now this one is investing and trying to capture 2 times, which is 200%, the daily percentage of the common stock of Tesla. We've seen these before, and some have worked well, some have done, not so well. But what they basically are doing in their holdings, you can see that there's 2 sections that they have. They have US dollars on hold. They have the US T-bills, which is not uncommon in an ETF. The T-bills basically, as you can see, from 08/12/2025, normally they'll put a percentage of what they're paying in an interest rate on there. But that gives them that 30-day SEC yield that they got continuous funds coming in from interest payments for a chunk of the money. Everything else you see below are their put or call options of what they're trying to sell. Okay. And this is where they generate the money from. These things are going to turn on a daily basis. If every day I pulled this up, you'll see their holdings. The first 2 are probably identical. Percentages may be off a little bit, but below that, everything there is going to be totally different call options. They're either going to be buying or they're going to be puts, which are going to be selling across the board, trying to capture as much as they can. And with Tesla, with that thing bouncing up, down, sideways, this is a very, very aggressive and active account. Now, if we take a look at the performance that they've had, now this one here has been out a little bit longer than the other one. So this is a fund that they had that they rolled into the weekly payers. And you can see this thing basically early March took a drop and went straight down rock bottom and have scraped bottom prior where we're sitting. So the performance is not real strong. 1 month, they're down 14.48%. 6 months, they're down 55%. And year to date, they're down 51%. Now, their expense ratio, again, you're going to find this across the board with weeklies is 0.99%, is the incentive that a lot of the ETF holders will do. They're picking up more percentage costs because it is a little more costly to do weeklies. And as I said, this fund started off in December of 2024. So realistically, we're about 6 months heavily into this and seeing what we're going through. So at the first step in my head says, probably fairly common. The thing was doing well at the beginning, and now, making different changes, not performing the way they wanted it to, and thinking weekly is going to make a big change to it. The past 30 days average, this thing was at $11.93. The rock bottom is $10.59. So you got to make sure you stay within these parameters and hit this. And I believe right now this thing's about $10.74 as we record this. So it really puts us in the magic point, even with the poor performance that we're seeing, that it's really a chance, an opportunity to buy this on the down low and let it produce its dividends and possibly some good increase in returns. So this is the one that I put on there saying, hey, this is probably a stock that we want to invest in right now. Even with the signs of the performance showing some negative, some heavy negativity. But when we look at this was a $25 stock. And now we're almost at the rock bottom. And there's only one way to go with this one, and that is up. And when you're dealing with Tesla, that's being controlled by the news. It's being controlled by, what Elon's doing, what Trump's doing. And I always want to tell everybody, Tesla is not a car manufacturer. It is part of their portfolio. They are a technical company. They are one of the mega sevens. These guys got more things coming than down the pipe. So I would kind of put my money back behind this one a little bit. Your dividend chart. Now, again, remember, we switched to weeklies in June, and that's why you see the big drop off. But this thing was paying basically a little over $1 for each dividend that they put out. And it was on a monthly basis. So now they're down to 30 cents. Well, 30 times 4, let's calculate that, about $1.20. So the dividends really aren't changing. You're just going to get your money on a more regular, continuous basis. Now, because of all these changes, the percentage rates are going to be floating all over the place because the math and the calculators are doing what they're supposed to do. So they advertise 147% dividend, which we all know is not realistic. I calculated it out and got about 73% using the data that they have that we're access to. Comes in about 73%, and we'll show you a little bit later what we've actually been able to capture. So our next one we're going to talk about is the TQQY, the yield burst of the QQQ ETF. And that's basically, they're looking for the down movement of the NASDAQ 100. Now that's unique. That's something that people don't always think about, is you're always looking for growth. You're always looking for the positive. These guys are actually looking for the downward movement. And in today's trends, probably a very good point to be at, because there's stocks that are going up and there's a lot that are going down. So in their holdings, again, you're going to find this on a very continuous basis that, they're going to have money sitting aside so that they can do their basically, they can do their calls and their put options and all that. They're going to have T-bills that are going to generate monthly, regular, standard income, which you look at this one, 65% of it is in T-bills. And then you have the put options that they have put out there. And again, they're going to put them out there. They're going to play. They're going to try to generate income from those particular moves. So they're buying and selling put options in the NASDAQ 1000 or 100. When we look at their chart, again, from the day it starts, it was at 2409. they're down to about that, just a hair below that $20 price point. Their performance, 1 month down 2.26, 6 months 23.75. Ratio 9.99%. Expense ratio. Now again, this one came out in February of 2025, so we're looking up maybe a 4-month performance as we sit right now. The past 30 days, the average is $18.85. The bottom has been $17.52. And you can see, this is where I talk about the current price is $19.07. So we're already above the 30-day moving average, and we're also way above the bottom of $17.52. So what we don't know, because these things are so new, what is the high, what is the low, where is a good buy point, where is a good entrance point, exit points. These are the things that we have to learn. Now, we are very patient with that, and we will give up, 12 months. We'll give up time to find out those magic little areas before we jump in full bore. We're doing it here on this presentation just to give you guys an example of, if you jumped in with both feet today, where would we be? So 1907 is the current price. It's not too bad. Again, I can't give you a positive or a negative of where to be in this one as of yet. We look at the dividend. Again, this one switched June of 2025. And playing the numbers, the dividend rate, 49.32%, is really, if it stayed at 18 cents per share across the board, reports come back at 14.16 because they only have a few short periods that they can calculate this into. So I'm really on this one, I'm leaning more towards that 49% is a realistic dividend rate coming out of this fund. Now we go to the YSPY, the yield burst of the S&P 500. And the holdings that we see on this one, same old, is T-bills. You're seeing the 617 and the 812 T-bills program. You're going to see on this one, they're doing all puts currently. They're looking for the negative of the S&P 500, and they got a little almost 40% of their money in cash so that they can continue to do more call options out there. So they have the money to buy and sell and hold and do what you need to do. So very conservative, but very, at the same time, I'll say aggressive of their moves of what they're trying to do. But they're also showing that they are going to give you some standard continuous payments that they can cover the dividends from the T-bills and any profits they can make from their call options. So when we take a look at this one again, the performance, 1 month, they're down 4.43. 6 months, they're down 19.77. 0.99 expense ratio. And this one came out in February of 26. Now, just like the last one, the past 30 days, they're at $20.18. Their bottom was $19, and they're currently at $20.30. So where does this one fall into again? I can't tell you. I believe these are times to buy. I think these are areas that you want to put a little bit of cash into to get these lower level numbers. But when you're above the 30-day average, I'm always skeptical of, do you buy or not buy when you're looking at that. I do see the chart is saying that we are slowly heading to a positive mark, but I don't expect these things to rocket like a regular stock would. I expect this to be the one that just takes the slow little inclines and slowly advances up. So these are ones that you're going to be buying on any drops, any dips in the thing. That's when you're going to want to buy. That's why you need to know your bottom, and you're going to need to know your moving average to see if it's a good enough buy of where we're at. Dividend chart. It sounds like a broken record. They switched in June of 25. They're down to 19 cents per share. they were getting just a hair. I believe it was 78 cents is what they were getting on a monthly basis. So you're basically they're not giving you anything special out of bounds. Is they're just taking that dividend, dividing it by the 4 weeks, and pretty much giving you the dividend that you're working with. This one comes in again at 14 to 49.32%. We've done our calculations, we've done our work around, and we come around to that 49%. It's probably going to be a real accurate number for these. These are great dividend numbers. Time will tell. Will they hold true? We believe they will, but we're going to keep an eye onto it. The next one, the yield-based NVYY, Nivea, and they're again going like the Tesla program, 2 times long on the daily stock. 40% of it is in cash, 62% of it is in T-bills, and then they have their two, actually their puts that they've put out there. Again, this is going to be one that will be a constant change, almost on an hourly, daily type basis, that you're going to see they'll have more put options. They'll be turning around getting call options. They're doing what they feel the stock is going to do. They have the cash to do it. And then they turn around and they have their money tied up in T-bills that will help cover the dividend expenses. Now, here's the great one. This one comes out of the bag and when it started. And what's unique about these, I want to just throw this one to you. If you've looked at the starting prices of any of these stocks, you're seeing that they're all starting in that bid 25, basically $25 range. When you see other weekly paying stocks, they're all starting off at the big $50, $60 range, and then we have the big NAV cut into it. The reason for it is that they're trying to generate as much cash as possible. They're trying to get to that $100 million mark as quickly as they can. That's why you see people with such a big price tags. These guys are different. They got the backing of the financial backing. They got the Bain Capital behind them. They can start it where the price should be, where they expect it to market out at, $25. You take a look at NVYY, they're already up 4.8%. Now you start looking at why the other ones that I looked at, I think these are buys. I think these are areas where we could possibly be in the play to buy. You cannot relate one stock to another, but what you can do is the performance of the company. What are they doing? The expense ratio, 0.99. This one came up 513. So we're just shy of a month old. Their 20-day average is $26.02. Their bottom, $24.66. And their current price of $26.71. So right off the bat, this probably looks like the most shining star that has positive growth. It's gaining momentum, and it's doing some decent performance. But again, we don't have enough data for me to lock in and be 100% behind you saying buy, buy, buy. What I'm looking at saying, possibly I'm the hesitant guy. That's why I'm going to say that we're going to let this thing run out and we're going to keep updating. Now, they've only had one dividend payment since they are brand new. They gave out 50 cents, which was great. And if you calculate that out, you'll find out you have a 98.3% dividend rate. Guys, all I can tell you is time. Time is our best patience of this. XBTY, which is the Bitcoin ETF package. This is doing 2 times long Bitcoin daily. You're going to see the same things here. 35% of the money is in US dollars, 64% in T-bills. And again, they have 2 put options out there currently, which will die in 2 days from now. And then you'll see things added on a regular basis. They will be buying and selling put options on this one. They'll probably be doing some call options as well. Is all how to generate 2 times what you're getting from a Bitcoin performance. How does this one look? Well, they're up 0.39%. Again, you look at the starting point, $25, $25.50, and currently, as the recording of this, is $25.64. The expense ratio is 0.99, started 513. Past 20-day average is 25.83. The bottom is 25.42. Current price 25.61. So we're a little bit below the 20-day average. We are above the bottom. So if we had more history on this one, I'd say, guys, this is the time to get involved to this one. We're going to see some growth. We're going to see some adventure that is going to go upward. But we're sitting in a great spot to have our money invested into. Look at the dividends. You only had one payout, 46 cents. This one would pay a 93.6% estimated. So the ETF lineup, the 5. You got TQQY, it's about $19 stock, 49% dividend return. TSYY, which is the Tesla program, $10.92. That's why I look at that one saying this could be a game changer. 73.47% dividend return. YSPY is the S&P 500. They got a $20 price stock and $49.32 or 49% dividend return. And then NVYY and XBTY, the Bitcoin, and then are both in that high 90% categories, all in that $26 and $25 range. So we got an average between the 5 shares of 72% return in dividends. Very, very impressive numbers. Will they hold up? Will they continue? We don't know. So let's talk about the purchase. Really, the question is going to be, is this a good investment or a waste of our time? Well, I always hate wasting money, and that's what waste of time is. So I'm hoping this turns into a good investment for us. So what we basically did, because we just couldn't come up with any hardcore picks, we bought all 5 funds. We bought them on June 2nd. We invested $1,000 per fund for a total of $5,000. They are all weekly paying dividends. Of course, that's what this is exciting news is about and reporting. And what we're going to choose to do is we're just going to do the regular cash flow out. We are not going to try to drip this. We may try this in a later date, but right now we just want to see if the funds are going to produce. And if they're going to produce, is it going to be through growth or is it going to be through dividends? What we're hoping to do, our goal is to get a 15% average return and a growth of 5%. So what my average return is that I'm trying to get 15% dividends from these 5 funds, and when I get a growth of 5%. So basically 5% of $5,000 is $250 over 12 months. 15%, that's what we're trying to get in dividend payouts. I believe the dividend's probably going to be too low for the goal. We're probably going to blow that one out. I'm really watching, can we get that 5% growth? So Doug's picks, as I said, we picked all 5 of the funds. We put $1,000 in each to it. So you can see we have, I won't go all the way through it, but 53 shares of the QQQ. We have 85 shares of the Tesla because of the price. Here's the thing I already looked at. Our stock value after our first week is down 89 cents or 0.02%. And that realistically is coming from the Tesla stock that I told you earlier. We bought at $11.69, and as of June 10th, it was $10.92. So we've lost in value of that one. Everything else is up. I would be blowing a horn right now if we didn't buy that one Tesla program, which I told you is going to be up and down. But we're basically 45, almost $60 up in all the other funds. But our big thing that we're excited about is going to be the dividend value. We've collected in 1 week $82.46 or 1.65 percentage points. So in return, to give you a quick summary, we'll do that for you is again, we're down 89 cents from our $5,000 investment. We've collected $82.46 a week or 1.65% in dividends. That gives us a $4,288 year-end return or 85%. As I said, that's well above that 15% that I would be comfortable getting from this, but $4,200 looks awesome from the start. Guys, this is Doug, the retirement guy. I know we took a little bit too much time this week, but hey, here's the thing. If you like what we're doing, give us that thumbs up. Don't miss any of the videos. We have so much going on, especially with weekly dividends every week coming out with new videos. Hit that subscribe button. And if you want to support the channel, don't forget, become a member. If you were a member of this, you would have gotten this video ahead of time. You would have already seen this and been able possibly even to buy at some better deals. Leave us a comment below. What do you think about the new weeklies? And what do you think we're doing? Are we doing it right or wrong? Everything helps our channel grow because we're trying to help your pocketbook grow. We'll catch you next time.